G'day expats and welcome to another episode of Expat Chat, episode 159 today. And as always, I'm joined on this Thursday with my mate and colleague, James Ridley, who's the Managing Director for the APAC region. G'day, James.
Good morning, Brett, and those who are joining us on the YouTube channel. To my left is Brett Evans, the founding director for the Atlas Wealth Group and the managing director currently for the EMEA region. And I say current because you just never know where we're going to pop up next as we continue to grow. Good morning, mate. How are you?
Hey, all well, thanks. Well, it's all good in the hood here. It's a sprint to Christmas. My daughter politely responded that it's less than 100 days to Christmas. Not that she's counting, but obviously she is. So probably a guess there. Young girls are like, they're
Yep.
great at subliminal messaging and, sort of just
Oh,
put that
yeah.
stuff in there. So
Here's my list. Here's my list.
pretty much I'm waiting for it. It's just she loves to butter me up and sort of layer that thing up anyway. So mate, all good here and weather's improving nicely. We're coming to the best time of year in the Middle East. So
Beautiful.
looking forward to it. So how's things back in Oz, mate?
Mate, all's going well. All's going well. It seems like we're sprinting into summer at the moment, and I know we're not weathermen, but God, it's going to be a scorcher this time round. Gold Coast office is great, growing again, taking on another team member, always exciting. Mate, not much else to report at the moment. Just obviously sprint finish to Christmas, which again, we're nearly coming to the end of October now, so it's a little bit
Yeah.
scary. 2 more months. It's just crazy.
And a bit of a, public disclaimer for the folks out there to say if you do want to get your stuff done in place, sorted, so when you start 2026, you are locked and good to go, do it now. Now's the perfect time to do it. We say it to all clients, October, November, I call it my German Shepherd time, GSD, get shit done. And, you should, because then, let's be honest, you're not going to get work done over Christmas. And then come January, you'd be still reminiscing over Christmas and not thinking about work. And the last thing you want to talk about is tax and finance. So if you are taking control of your finances, getting your shit done, do it now. Do it now. So
Absolutely. Hit the ground running. Hit the ground running in the new year. Set up those goals. Hit the reset button now. So when you're entering 2026, you've got your systems and your processes down pat. So that way you're not spending the first 3 to 4 months getting it all up and running, feeling like you're not really getting anywhere. You're obviously treading water. Hit the ground running 2026.
No, spot on. And then let's let the good folks out there know what we're talking about today. So we're talking about how expats can invest for their kids, which is a common question we get. But before we go any further, let's get the jingle out of the way. All the information we are going to share with you, amazing people today, is going to be treated as informational and educational purposes only. Please do not construe this as personal advice. If you do need to get personal advice, speak to an expert, speak to Atlas.
Absolutely, mate. And today's topic, it's front of mind. A lot of clients do ask us, I want to help my kids in the future. I want to put something away for them. I want to invest now while they're really young. I mean, I can relate to this. I've got a young one. You've got young ones. And you're trying to put something away just to, give them that little head start for when they are a little bit older, a little bit more independent. And there's a lot of different ways that you can do it. And I think a common one that we come across, the way that clients approach this is they look at probably financial products back in Australia and they go, okay, well, that's a child investment. I can set that up. But we've always got to remember, zoom out again, you are an Australian expat. You are a non-resident for tax purposes. So does that structure or that investment bond or assurance bond or whatever it might be still make sense given some of the tax concessions or lack of tax that applies to you on certain asset classes when you are a non-resident of Australia? So that's sort of where we try and start. We go, okay, these are the available options, but they're probably not relevant given your non-residency status. And I think when we look at probably the most common structures in Australia, I think I'll start with probably savings accounts. A lot of banks offer sort of minor savings accounts or use savers where you can set up as soon as the kid is born and put money in it and, get some bonus interest on it and then it grows. And the next part is like, well, where does that interest income get declared? Because that income needs to be declared somewhere. And with a lot of those savings accounts, you've set it up on behalf of your daughter, your son. It's most likely a case that you'll have to declare that income in your own tax return. So that's probably the first type of account that I commonly see, just a use saver or a bank for the new bub that gets started, and then usually have family as well as yourself, you guys might contribute, a couple $100 here and there over
Yep.
time, and it keeps growing. So that's sort of part one. That's not a bad option by any means for whether you're in Australia or whether you're an expat. Nothing against that at all. You are a non-resident though, so remember it's going to be non-residency, 10% on the withholding tax for interest income on that, and you're just obviously that's all that needs to be done. The next step is usually some sort of investor account or brokerage account, and often the way those are structured, and this gets a little bit more complex, but often the way these are structured in Australia is you can set up a minor investment account with one of the platforms when you're in Australia, normal tax resident, and you're actually inadvertently creating almost like a trust. And it's really strange because you're not going to an account and go, hey, I want to set up this trust. That's not happening. But when you open up this account, you're opening up a minor account and you're the trustee, but your I suppose your kid is the beneficiary. So you're contributing money into it, and then there's going to be dividends. There's going to be capital gains in the event you're changing the assets. So the next step is, well, how does the accountant declare the income on this? And if it is a true minor account and an informal trust that's been created, then the account has to layer the minor taxation rules on there. And right now you can only distribute $416 to a minor, which is tax-free. And then after that, you actually pay the highest tax rate on any amount over $416. And the reason
Yep.
why they brought this in a long time ago was to disincentivize people setting up family trusts and distributing money to their kids, because kids were a great little tax vehicle
They
until the
were.
AG said, we don't.
I
Yeah,
call them cost
exactly.
centers, but sometimes they're useful.
Exactly. So they were useful. Now they're not. Now they are just cost centers, but they attract the highest tax rate after that $416. There are some ways to change that treatment of an informal trust for the minor, and it depends on how you're using the funds. And an accountant actually has to make a decision on that, whether it goes in your tax return or their tax return. And that's the other thing. If it is a true minor trust, you actually have to get them a tax file number, even though they might be 6 months old, because then you have to
Yep.
do a tax return for them. So you're just increasing a bit of admin there, and you just want to be a bit strategic. The next one that we commonly see is the education savings bond of some sort, or investment bond. It's set up, you're the beneficial owner, the child is the beneficiary. These investment structures operate around the 10-year time frame. Whatever you're contributing, it needs to stay in there for usually 10 years. And then after 10 years, it's all tax-free and you can pull it out, do what you want. If it's a true education bond, you can pull out money usually any time and make a stat declaration to the education bond provider. And that's also pulling it out tax-free. So there's different layers to that. The other benefit is you pay tax as you go on the investments each year based on the capital growth. So you're doing a mark-to-market election automatically within the bond. But the true benefit is just the fact that when you pull the funds out after 10 years, it's all tax-free. So that's where a lot of people, especially high income earners, might lean on that, just because you're not paying tax in your individual marginal tax rates, which go all the way up to 45% plus the Medicare levy. You're just paying tax at the bond rate, which is anywhere from 25 to 30%. So that can be beneficial. And then the last, I suppose, structure which could be used if you're in Australia is a family trust. You've got a trust set up, it's got other investments in there. You might put another investment in there into a different portfolio, but it's designed purely for the kids. And the kids are going to draw down on that when they're 20 or 25 and distributions are made through the trust. And if they're no longer treated as a dependent or a tax dependent, and they're working full time, then you can put this income down on their tax return. They're paying normal adult marginal tax rates on it rather than your minor tax rates. So those are probably a quick example, high level, of the most common structures that we have access to when we are in Australia, an Australian tax resident that we might employ. But when we're a non-resident, we don't need to look at using those. And I'll kick it over to you now, Brett, in terms of what's some options or an option that we could use when we're just a non-resident.
Well, it's a funny thing because, as you're talking, I'm imagining all these different products being lined up on the desk. And then when you become a resident, you just grab your arm and just swipe them across and get rid of them, because most of those
Yep.
things you've talked about, you use for tax reasons,
That's
whereas
right.
tax doesn't
Yep.
become a problem for non-residents, because guess what? Surprise,
Correct.
surprise, non-taxable assets. There's no
Mm-hmm.
capital gains tax. So people have this compulsion, and we talk to clients a lot about it, is they want to have an account set up for their kids and do this and do this. And I'm like, but then you got another login, another application form, another this, another that. I said, just keep it simple. With your existing investment account, select a global ETF, like an IOO or something like that. Nice and, especially if you're looking
Yeah.
at, you've just had a baby. Let's talk about
Long
H-Man.
term.
Your little
Yep.
one, is, less than a year old, so not even 6 months
Yeah.
old. So he's
Yeah.
got 18 years. If you want to gift him that money at 18, he's got 18 years of growth. So you're not going to put it in
Oh
your
yeah.
bank account. You know,
Fuck no.
yeah, there's too many good gains you can get on a compounded basis. So shares and ETFs are the obvious option. You could set up an account for Harry or Harvey or Harriet or whoever your kid is. But there comes with that more compliance burden, more paperwork, more costs and fees and charges.
Yeah.
Most people, our clients do anyway, have an investment account. Guess
Yep.
what? Just put a bit of money aside and put that into their account. And guess what? Just lock it. So you're doing a bit over here, but on this side of the account is your kids' money. And they can see it,
Yep.
you can see it, and then suddenly you're not paying any extra for the privilege of being able to do it. It's easy, accessible. I've always said to clients, if it's easy, you will do it. If it's hard, you won't do it. So by bringing that into your ecosystem of how you normally manage your money on a monthly or quarterly basis as an expat, it's going to be so easy to do. You put some more money in your portfolio, money in your kids' account, so money in your kids' investment, happy days, done. One transaction.
Yeah.
Don't make it any more
Yep.
complicated than it has to be, because if you do make it complicated, the more the friction, the less likely you are to do it. You'll forget about it. Oh, I'll catch up next month. And then 2 months goes by, 3 months goes by. Keep it easy, keep it simple. And then when you go back to Australia, then you can explore all these other options that you're referring to. But for the time being, when you're overseas, keep it simple. By keeping it simple, A, zero capital gains tax, bingo, that's a winner. But B, simplicity. Good financial advice is elegant and simple. It's not complicated. And we don't have to look at all these convoluted structures to make it work. In actual fact, you want to go the other way around and make it simple.
Absolutely. And unfortunately, a lot of the products back in Australia, they're not cheap to run. Like those investment bonds,
expensive.
They are. They're really expensive when you look at the fees and the underlying management fees. Because a lot of these types of investments, these education bonds, like the investment menus are really small. We're talking 15 to 25 managed funds, and that's it. You can't access shares, you can't access ETFs. So you are hamstrung by your options there. And they can be complex to understand as well. There's this rule, generally this 125% contribution rule, which states that with these investment bonds, let's say for year one, you contributed $10,000. And then in year two, you put in $20,000. Well, you've breached the 125% contribution rule. So unfortunately, you've reset the bond now, where year one wasn't last year. Year one is now the year that you've put the 20,000 in. So it means if you kept doing that, you're never going to get the tax-free benefits of the bond, because you accidentally keep resetting it. And then if you miss a year of contributions, you can't start the next year with new contributions, because remember, the 125% rule states that you can only contribute 125% of the previous year's contributions.
Yep.
Exactly. So zero contributions in year two means you can't put anything more in year 3, 4, 5, 6, 7, 8, 9, 10. You have to start a new investment bond. So often they're hard to follow, especially when you're running it by yourself. Whereas as a non-resident, keep things simple, separate line items, separate mini portfolio under your investments, tax-free, withdraw it when you need to, complete flexibility. We want tax efficient options always. When you come back, that's when you can get a bit more nitty gritty on the favorable tax structuring.
Definitely. No, I think I couldn't say it about myself. And, life is complicated enough as it is. When you become an expat, it goes to a whole new level. Keep it simple, guys. Really keep it simple. That's the best way I can describe it. It's something that I think we love the complicated, because we can, at the barbecue, oh yeah, for little Johnny, I've done this and this and bloodline trusts and all this sort of stuff. Sounds awesome. It's an absolute complete nonce when you're an expat. Complete.
Yeah.
So to me, keep it simple. Just keep it clean. If you can, monitor and engage with it, it works. If the friction gets too high, becomes too hard, you're not going to do it. You self-select out. You'll find any excuse under the sun, to not do it. Oh, no, I was busy. You got to cut my toenails or something like that. I'd rather do that than and then contribute to the investment account or something. So keep it simple.
Yeah. Yep. Absolutely, mate. Couldn't have said it better. Like those are the simplest ways the most simplest way you can invest whilst you're a non-resident. When you come back to Australia, resume. If you're unsure, reach out. Obviously, we can lay out a few options for you because there are some good ways to tap into some of those tax benefits. But yeah, the harder it is, the less likely you are to actually use it and follow into it.
Yeah, I think, and that's the thing. You also raise another good point as well too. When you are building a strategy, you need to demarcate the strategy based on residency. If you're a tax resident, do X. If you're a non-resident, do Y. Don't try and blend it over both because it's not going to work that way. You know, you need to lean
No.
into the residency and how those rules are written to take advantage or mitigate the tax scenarios that play out. So don't just try this set and forget approach. It doesn't work. Will you get a result? Yes. Will it be the best result? Hell no.
Yeah, absolutely, mate. That's probably a good point there to put a pin
I
in
think
it
we'll
for
put a
today's
bit in that.
episode.
Bit of
Yep.
housekeeping, more events coming
Yes.
up next month. So next month we have our yearly review, the year it was and what's coming ahead. So we'll pontificate and hypothesize about markets going forward, whether that's
Everything.
gold, equities, currency, property, you name it. We'll have an
Yep.
opinion on it. Not always right,
Tax.
but most important right. Tax is a big one. Yeah, it's the governing, it's the
Yeah.
North Star for us. But
Isn't it?
so keep an eye on our website, guys. We should have that up to register in the next week or so, I'd say.
Yep.
So Joe, our marketing and communications manager, is working away in the background to get that all squared away. So we'll get that up. Make sure you register. Webinar online, accessible anywhere in the world. So there's not a time zone that we can't help with in terms of having that live webinar. So make sure you register for that. And guys and girls, if you do want to get your GSD, you'll get your shit done before Christmas and before you give yourself permission to relax, get into it now. So,
Yep.
you know, there's still plenty of time to be done, but you want to be that person who starts 2026 with everything done. Everyone's making lists about, you know, New Year's resolutions and stuff. You're all good. You've already done yours. You can just get on with living. So yeah, that's my only little, you know, sort of what do they call it? The public announcement, you know, public service announcement, PSA.
PSA.
Yep.
Yep.
Just guys, 2 months to go, sprint to the finish, get it done. You'll love yourself for it.
Absolutely, mate. Couldn't have said it better myself. Thanks for tuning in on another episode, guys. See you on the socials.
Thanks, guys. Thanks, James.